Welcome to the Westside Investors Network, WIN, your community of investing knowledge for growth. This is the Real Estate Professionals Investing Podcast for real estate professionals by real estate professionals. This show is focused on the next step in your career, investing. Thank you for listening. And please, if you like our content, rate us on your podcast provider. Just a quick disclaimer, the views and opinions expressed in this podcast are for educational purposes only and should not be construed as an offer to buy or sell any shares or securities, make or consider any investments, or take any other action.
Welcome back to another episode of the Deal Deep Dive segment on the Westside Investors Network podcast. I'm your host, Trent Werner. In this segment, our featured guests will share their unique stories on a specific deal they've invested in. We will dive deep into finding the deal, financing the deal, writing an offer, and the due diligence. Do us a solid and smash that subscribe button, leave us a rating, and share this episode. And now, let's dive deep. Welcome back to the Westside Investors Network podcast. I'm your host, Trent Werner. On today's Deal Deep Dive episode, we are joined by Arn Cenedella of Spark Investment Group. We're going to hear about Arn's career starting as a broker in California, beginning his investment journey with single-family real estate, and transitioning in 2020 to multifamily real estate and syndications. Now let's welcome Arn Cenedella. All right, Arn Cenedella joining the Westside Investors Network podcast today. Arn, I'm so glad you're here. Thanks for joining us.
Hey, Trent, happy to be here. Looking forward to having a nice chat, and hopefully we can help your listeners on their investing journey.
Awesome. So Arn, you took a path in real estate that involved single family investments prior to your vast multifamily. I think a lot of people are in a similar boat or would like to be in a similar boat to you. Can we talk about how you got started in real estate and that first chapter of single family investment real estate for you?
Yeah, sure. So grew up in the San Francisco Bay Area, typical middle income American kid, was told, study hard, go to college, get a degree, and did all that. Ended up with a master's degree in chemistry from the University of Michigan. Then decided academia wasn't quite for me, wanted to return to the Bay Area. And my father had a residential brokerage business in Menlo Park, California, which is next to Palo Alto, basically Silicon Valley. And my father, Hal, said, get your license, come out, I'll put you to work. And that was March of 1978. And I've been in real estate full time ever since that. My father was an excellent broker, but even more importantly, he was an investor, very good investor, invested in single family homes, and then eventually transitioned to office buildings, skipping multifamily, which is kind of interesting. I started kind of following his footsteps as the brokerage business grew and I made more income, started investing in single family homes. And back then in the San Francisco Bay Area, you could actually buy rental houses that kind of made some kind of sense. I don't know if it makes sense today. Then had the good fortune to go to Austin, Texas in the early 2000s. And I think most people understand Austin's been a pretty good market. And that would take me up to about 2020 when I made the transition to multifamily.
And so, similar boat to me, right? I started selling single family, small multifamily residential real estate, and it made sense to invest there. Is that why you started with the single family?
Yes, I think it's a logical progression, and I probably started like a lot of people. Maybe your story similar. You buy your first house, and that's a big milestone. You had a dream of owning your own home, maybe for a couple years, and then maybe you need a bigger house. You're starting to make more money, so you go buy that second move-up house. And so I kept my first house as a rental. And I think that's the way many people do it. And to me, it makes logical sense. Buy one house, keep it, buy the next, and then you start accumulating. So that's how I kind of started. The Bay Area I knew was a good market to invest in, was kind of following my father's model. And that got me off to a good start.
And How far did you take single family? How many units did you end up getting to?
I would think at one point, maybe 30 to 35.
Okay.
Yes.
Was there
And oh, go ahead, Trent.
was there any small multifamily mixed in there?
I might have had one or two duplexes along the way, but that was probably about the biggest that I did. Yes.
Okay. And then what took you to, I guess, when you were investing and when you continued to invest, I'm assuming you remained a broker the whole time, right?
Correct.
And do you still sell real estate today as a broker?
No.
Okay.
I much preferred being an investor. And don't get me wrong, I love the brokerage business, and you develop close relationships with people, and that's great. But being an investor, kind of being the actual decision maker, does afford some benefits. So I really don't do any more brokerage activity per se, and I concentrate full time on my investing.
And when you were practicing as a broker, how or did you ever help clients follow in the same path that you did?
Yes. So as brokers, you want to kind of develop as many sources of business as you can. So you got your owner occupant buyer, that's great. But when you can start working with investors, that opens another kind of market to you. And investors tend to buy more than one. And they tend to buy a more than every 2 or 3 years or 5 years whenever people move. So yes, over the years, I help many people kind of start building a portfolio. Um, most of them had full-time, very demanding Silicon Valley careers. So they never scaled to the same size of my portfolio, but they did pick up rentals. And at times I would partner with them. So that was a significant part of my business. People can use the tax deductions. In Silicon Valley, a lot of people have stock, tech stock, and they appreciate the ability to diversify into another asset. So the real estate, the hard asset, really made sense from a diversification point of view for many of my clients and investors.
And what took you to Austin, getting out of Silicon Valley?
Well, I didn't move, so I stayed where I was. And actually, an investor friend of mine down in San Diego kind of turned me on to Austin. And he actually had a connection with the builder who was building a tract of new duplexes. And that was my first acquisition in Austin. Austin, state capital, state university, plus tech is a pretty potent formula. And I think even back then, people knew Texas was kind of booming. It's a favorable, I think it's a no income tax state, if I'm correct. I may be wrong about that. But, three strong economic drivers. The tech was certainly familiar to me coming from the Bay Area. And I ended up buying a couple duplexes and a few single family houses. This would have been in the suburbs north of Austin, in towns like Cedar Park, Leander, and Hutto. And, fortunately, picked a good time to get in, and, they served me well.
So you did your single family chapter. You closed the page on that one. Now you transitioned in 2020 to multifamily. Why did you want to start that next chapter?
Yeah, that's a good question. And my answer may be a little strange, but for one, I wanted to do something new. So I had done the single family thing for 3 or 4 decades. It did well. But I think, to kind of keep interested, keep your mind occupied, it's always good to learn new things. And it's a relatively straightforward transition. They're both residential, right? It wasn't like I went from single family to industrial buildings. I just went to a different type of residential. And at that time, I had moved to Greenville, made friends with a young investor buddy here. And one day in March 2020, when COVID hit, when we finally really knew COVID was a real deal, he called me up. He goes, "Hey, Arn, what do you think's going to happen to rent collections now that COVID's here?" And it was the middle of March. So I told Mario, well, reach out to me April 5th and I'll let you know how the rent collections had gone. At the end of the podcast, he turned me on to a multifamily podcast and it just kind of clicked. We know housing affordability is a real issue in the country. The most affordable housing is probably either mobile homes or apartments. And so there's always going to be strong demand there. So I felt it was a good segment to get in, kind of affordable housing, because that's really where the real lack is. There's plenty of $3 million houses, but there's not as many affordable housing units. The other thing I like about multifamily is the notion of scale. And you could think about it, you could own 20 houses in your city, and they're all great little rentals, but they're spread out all over the place. Where if you buy a 20-unit apartment, all 20 income producing units are in the same place, under the same roof. The other thing that's nice about them is the units tend to be identical or very similar. So once you kind of come up with a plan of how to renovate them, you don't have to reinvent the wheel every time. You got some 1-bedroom units, you got some 2-bedroom units. You figure out how much cabinets you need, how many counters, and it's just rinse and repeat. And then I think the one of the other ones was multifamily tends to be a little bit more of a team sport where generally what I see is 3, 4 people get together to kind of form a team and tackle this multifamily, where single family is maybe a little bit more of a solitary experience. So with the team approach, you can partner with people who have skills that you don't have or that you're not good at, or maybe that you just don't enjoy. And so on my team, I'm kind of the deal hunter. I like getting out there, trying to find the property, talk to people, talk to investors and sellers, network with brokers, go out and hunt those deals. I don't enjoy as much the day-to-day operation. So I have a partner who loves day-to-day operation, doesn't like networking. He just wants to take care of the properties. He does it great. And then our third partner is kind of our analyst, spreadsheet geek, loves diving into the numbers, has a career as a CFO, which he left due to his real estate investing. It took him about 10 years to get there. So I really like the team aspect of multifamily too.
You said you called yourself a hunter. This is a curiosity question. Have you ever gone through the Bigger Pockets multifamily boot camp?
I have not. I have
Okay.
not, but I enjoy reading Bigger Pockets and try to contribute when I have time. So tell me more about that.
So Chris and I, one of the other guys here, we did the multifamily syndication boot camp, and they broke it down into 4 different categories, and you pretty much just hit all of them. You said hunter, which is the deal finder, the brain, which is the deal underwriter, the money who raises the funds, and then the hammer is the asset manager, making sure the renovations and business plans are getting carried out. And you pretty much hit them all on the head. That's why that's why I was asking.
Yeah, no, perfect. And I've heard those names before. And in our team, all 3 of us raise money. So we have specific roles. We all raise money because we all have our own particular personal and professional spheres. And when people are trying to scale up and move into multifamily and find investors, who better to start with than the people who actually know you, understand your character, your ability. And so that's either through social, family, friends, and or business associates. So that's always a great place to start. And as you gain momentum and a little experience, then it's easier to go out to investors that maybe you don't know on a first name basis, let's say, and raise capital from them.
Absolutely. So you
Yeah.
have your team, you've decided to transition into multifamily. I want to talk about a deal that Spark has done. Let's talk about one. You said you closed one in June, a couple months
Ye-
ago, a few months,
yes.
I guess now. Tell me
Yeah.
about that deal. Where's it at? How many units? And how'd you find it?
Yeah, great question. So I'm in Greenville, South Carolina, which is the northwest part of the state, also known as the upstate. And it's really the only market we work in. So the last deal we closed was in Taylor, South Carolina, which is adjoining Greenville. It's Greenville County, just outside the city limits. 26 units in total, 13 13 duplexes that we bought direct from a builder when the units were completed. And actually, I made connection with this builder over social media. He's a local builder. We kind of developed a friendship. And one day he posts on Facebook, I think, hey, I've got this 13 duplex project. Anybody want to buy it? And I said, yep, I'm interested. So it ended up being total price about 4.625 million, about 177, 188 a door. And these were two-story duplex units, 2 bedroom, 2.5 bath, vinyl exterior slab, but we got luxury vinyl plank, granite counters. So pretty nice units. Had to raise about $2 million. And over the years, we've developed an investor database of, say, 75 to 100 people who invest with us regularly. We do 506B syndications that are open to sophisticated investors and accredited investors. Our minimum's 25,000. So what appealed to us was, one, the new construction's great. We thought the price per door was pretty good because we're all in at $160 a square foot, including the land. And I don't know about you, but in this area, it's hard to build for that amount, much less get the land in. The other thing that's happened is, I think most people in the multifamily space know transaction volume is down. And it's down because interest rates have raised. So we own quite a few existing assets, but over the last year or two, we haven't been able to meet with the seller on price. And if you think about it, you have a building, it's generating a certain net operating income, and that owner probably has 4% debt on it if he bought it 4 or 5 years ago. It's the same NOI, but now as a buyer, I got to pay 7% debt. So the reality of the situation, the property's worth more to the current owner than it is to me, hence the gap in price. So we got on the idea in this market, who's your most motivated seller? And I would say it's builders. Builders typically aren't long-term buy and hold investors. They build, they sell, they take their profit, rinse and repeat. That's what they do. So we've had good success buying some new build product here in Greenville, and we think it'll be a good long-term investment.
And now, here's a word from our sponsor.
Get things done while you're on the move. Learn more about working with a virtual assistant through Offsite Professionals. It's a great way to get all the things done that you need to get done. Have freedom in your time and streamline your life by automating your business. Stop spending time on the tasks that you can delegate and start spending more time on your superpower. Call us today at 503-446-3177 or visit our website at offsiteprofessionals.com.
Uptown Syndication is now offering a syndication coaching program for you to take your real estate portfolio to the next level. This is your opportunity to have experienced syndicators, AJ and Chris Shepard, coach you on your way to controlling your real estate investing future. Our coaching program will provide you with the tools and framework needed to begin syndicating real estate in your target market. Go to uptownsyndication.com today to learn more. That was my next question. So obviously Class A, brand new. You're not going in and doing a big facelift on it because it's just freshly done. What is your hold time? I know you said long term, but in terms of years, what are you thinking on this deal?
So I would say 5 to 10. But of course, there's an old expression, man plans and God laughs. So any investor has to adjust to the market. So right now, I think buying the new construction sets up well for a long-term hold, and are thinking about 10 years, because after 10 years is kind of when some of the major systems need to be redone, right? You're kind of low maintenance, low expense, 0 to 10. We got debt at 7% from a local credit union, no prepay, kind of the typical bank financing, 5 years. We did get 30-year AM, where typically they like to go 20 or 25. So I think our plan will be, hopefully rates will come down a little bit. And I think the expectations are now that they will. And I think we're starting to see, we're at the start of a declining rate period. Of course, what the Fed does doesn't immediately change what mortgage rates are, but it's a long-term indication. So I think our hope would be rates will drop here in the next 12 to 24 months, allow us to refinance out of that 7% debt. And realistically, I don't think we're ever going to see 3 again. I'm not even sure we're going to see 4, but I think realistically we can get down to 5. And so if we could get to about 5, all of a sudden the cash flow goes up. At that point, we'll refi for maybe another 5, 7 years with agency debt. And then at the end of that period, kind of have a decision that we need to make. I'm kind of, so with our investing, we don't swing for the fences. We kind of go for line drive base hits. So we like fixed rate debt. We don't over leverage the property. On this deal, we had to come up with about 45% down to make it cash flow. And then we have ample cash reserves. So ours is kind of more a long-term approach, kind of slow and steady, counting on the overall market, job growth, population growth to kind of win the day.
Yeah, and that leads me to my next question. So with an asset like this, where again you're not doing a big facelift and you're really focused more on the operation of the asset, what are some things that you guys have to plan for in terms of the operations, management, rent increases, rubs, that kind of thing?
Yeah, so already since we purchased it, I think we closed June 18th, so about 2 months ago to the day. We're fully leased, all 26 units at our projected rents. One improvement we've made, we've put in a dog park. So the builder did not include a dog park. So that's one improvement we've done. And then from there, yes, I think it's just a matter of being good about operations, and good operation takes some degree of finesse, right? Because you want to maximize rent, but you also want to minimize vacancy and credit loss, right? So you want to try to thread the needle where you can increase rent, but keep your existing residents. And on our other assets, we've generally been pretty good about that. And I would say these are 1,100 square foot townhomes. They're brand new. The rent we're talking about is relatively affordable for the market. And so I think as these leases come due, 1-year leases come due, if we ask for a 3, 4, 5% rent increase, which is basically $50, $75, I think most of the tenants will stay because they're living in a brand new building. Nobody ever else lived in it. And it's a hassle to move. And what rent are they going to pay? The other nice thing about the new construction is it's all separately metered. So basically the tenants are paying water, sewer, electric. So we don't really have any operational expenses other than taking care of the landscaping. And it's on a relatively large parcel, so the landscaping and keeping things cut down is not inexpensive, but we budgeted for it. And don't get me wrong, we love value add too. We'll do whatever makes sense. We actually own assets as old as 1970s to brand new construction and everything in between. We own stuff as small as 7 units and as big as 281. Though really our sweet spot is 30 to 50 units. we like that because it's a size you can get in and get control of the property. And if you need to turn it around, which you often do, you can actually turn it around in a year and be smooth sailing. With a larger asset, it's just a really heavier lift, and it's just more difficult to execute.
Couldn't agree more. And we're in a very similar boat with the asset size that we like to target. The other question I had for you is, when you're going through underwriting and new construction is a little bit different than what we are normally looking at. What are you looking for in terms of return metrics and, IRRs, cash flows, all that stuff, bird returns, that kind of thing?
Yeah, that's a good question. And so first of all, I would say in investing, there's the quantitative aspect and there's also a qualitative aspect that maybe doesn't show up on the spreadsheet, doesn't show up on the numbers. And by quality, it's a quality of the building, a quality of the location. And I think that to the degree investors can pay attention to that, they may be able to unlock some long-term value. So on most of our deals, I would say the returns to the investors are kind of 5 to 6% annual cash on cash return over a 5-year hold, and typically 13, 14% IRRs. So the numbers don't look fabulous on paper, but I would say this is kind of where multifamily is now, given the current debt structure. 2018, 19, 20, 3% rates, 4% cap rates. That was a once in a lifetime thing that basically was a response to COVID, and then our response to COVID in terms of printing money and keeping the economy going by lowering rates. So investors shouldn't think that's the norm. It's not the norm. And so I think the way we set up the deals, and at that, you'd basically double your money every 2 years. And I'm perfectly fine. Every deal we do, my partners and I put in a significant amount of the money, either 10 to 20% of the equity. So we're investing our money there. And I'm happy to get 13, 14% annual return. The other thing to realize is there's always a risk component. And I can tell you on all our deals, we've paid every distribution on time in the amount promised or more. And we've got money in the bank where really, if we didn't collect rent for a year, we could still pay the mortgage. So it's very secure. And each investor needs to kind of evaluate their risk reward tolerance. So ours are maybe a little lower risk, maybe a little lower return, but I still think a good solid return. So that's how we kind of approach it.
Well, and Arn, honestly, right now, I think a lot of investors would lean towards what you just described versus, thinking that they're going to get a 25% IRR with 8% cash on cash in 2 years and triple their money. When, we both know how that has turned out for some people. So I am never opposed to the get rich slow program and keep it secure program like you just described.
Yeah, and the other thing I would say, this isn't rocket science. If we all understand housing, we can evaluate it, and you just set it up properly. So the thing I would say is, does anybody really believe the price of housing is going to be lower 5 to 10 years from now? Is there anything in anyone's life experience that indicates the cost of housing is going to go down? I'm 70 years old and I've never seen it. Now, yes, there's momentary dips, but as all that does is kind of a logical and natural correction. And then it sets the stage for the next 5 to 7 year run up. So typically I kind of see 5, 7 years up, small correction down, year or two flat, and then you're off and running for another 5 or 7 years. And as long as you can kind of go through that little turbulent period, which I would say in multifamily has been the last 12 to 18 months, has the value of some of our assets dropped? Yes, because cap rates have increased. Are we concerned? No, because we're not selling. Is the property still cash flowing? Are investors still getting paid? So you just write it out knowing down the road it will eventually pay off. So I think if investors can kind of take that approach, they can kind of more safely and solidly invest for the long term. And it's not get rich quick, but I would say 5 to 7, 10 years of kind of a steady real estate investing program, you're going to be pretty close to being financially free or work optional. But I think it's more a 5 to 10 year consistent effort to get there as opposed to one deal and you're going to retire. That, in my experience, isn't how it works.
Yeah, I know, and I agree with everything that you just said there. And I also, I mean, this is another experience of ours, but we have a deal that we assumed a loan. This was 2 years ago, maybe now. And, we had to bring a bunch of equity to it because we were taking over the current loan. And it's very low leveraged, right? And when things got a little choppy in our local market, I had some initial concerns being the asset manager for this asset. And then took a step back and I looked at it, I go, wait, we're totally fine. There's no concerns. I shouldn't be concerned about this after getting talked off the ledge from some of my partners. But that, to your point, this deal that we're talking about, you did, you're 40% or 44% equity in there. So even if things do get choppy, it's so low leverage relative to other assets and investments people are making that it really isn't that concerning, even if there is a slight chop.
Yeah, it's just a natural cycle. So, like a couple comments about your partners and talking you off the ledge, that's a really big part of a partnership. Because I know when we get in a contract, we're doing due diligence, we're looking through the deal. Can we raise the money? Does this make sense? Blah, blah, blah. Each of the partners is going to have some days that are good and some days that are bad. And so then you need partners to pick you up. And the other way partners help is sometimes maybe one might get a little over exuberant about a property. And your partner's going to say, wait a second, Arn, slow down a second. Let's take a look at it. So that partnership give and take, and it's kind of an element of respect and trust. In my team, I'm usually the guy saying, let's go for it. And Dan and Brian are the killjoys who are saying no. And sometimes it frustrates me, but I've come to learn to respect their judgment. And the kind of way we do it now is unless all three of us are on board, it's a no. And if all three of us are on board, then we have a pretty good idea that we're on to something pretty good. So the dynamics of the partnership. The other thing I would say, date before you marry. My partners I've known for 8 years and 4 years. And you start off with one or two smaller deals, see how it goes. And if you and the team really click, now you got something. Now you can maybe formalize it a little more, but you don't have to rush to get married on your first deal. Kind of test the waters, make sure everybody is compatible, do what they say. You have similar investing philosophies, similar kind of approach to life. So it's important to be selective about your partners.
Absolutely.
Yeah.
Arn, I got a question for you. Last question on kind of your career and how you made the transition. But if someone is a single family investor right now, maybe they're a broker, maybe they're not, they have a portfolio of single family units and they want to make that transition into multifamily investing, what advice would you give them to take that leap and make that jump?
Yeah, great question. And first, I would say if you've built a single family portfolio, you have a lot of the skills and knowledge already to make the next leap. What I would say is, go out and buy a 10 unit or a 16 unit, a 12 unit. My first true multifamily was a 12 unit. And I partnered with a couple local guys. We had done a few flips together and we pulled some money. So I would say make an initial step up to something slightly larger. If you can do it on your own and maybe 1031 out of a few single family into a multi, great. If capital's limited, try to partner with a few people and go in and buy a little bit bigger building. Get your feet wet, get some experience. And then from there, start networking. There are plenty of multifamily conferences. Podcasts are a great way. I mean, I basically consume podcasts after that conversation back in March of 2020. I basically consumed podcasts for 3 months. I mean, COVID was going on. There wasn't much. I'd get on my bike and listen to podcasts. So podcasts are a great way, networking. And even I ended up having 2 mentors. So mentorship is valuable. And I can remember when I was doing my first deal and we kind of run into a little bump and I was losing my mind. My coach, my mentor, ended up talking me off the ledge. It's been a great performing asset. And the other thing is, as you get into this bigger multifamily, agency debt becomes a good option. But it's kind of funny. It's kind of catch-22. You can't get an agency loan unless you have agency debt experience. Well, how do you get experience if you can't get a loan? The answer is you bring in a partner that has agency debt experience, and then you kind of get that check mark on your diploma. And so now you could do that. So partner, maybe find a mentor, start slow, build up. And then I think the other thing I would say is you want to start building an investor database, but I think you go about that subtly. It's not, hey, do you want to invest in real estate? Or, hey, do you got any capital you want to invest? It's more, just let people in your circle know what you're doing. Oh, you meet somebody for dinner or a couple. Yeah, we just bought this 10 units over in Taylor, South Carolina. Or, hey, Joe, I can't play golf today because I got to look at the 6 units and easily. And you just kind of let people know that you're looking for multifamily, you're looking to scale up. And I think most people are interested in real estate. So those who are will kind of self-identify and they'll go, hey, Arn, next time you get a deal, let me know. So you just kind of start planting the seed. There's always a debate. Do you find the property or the money first? The correct answer is you work on both tracks at the same time. You develop your investor database while you're looking for property because you need both to actually make the deal come together.
I love it. That's great advice. Arn, where can people connect with you or hear more from you?
Yeah, so the name of the company, Spark Investment Group. I'm very active on social media, either under Arn Cenedella or Spark Investment, either Facebook or LinkedIn are my 2 primary thing. Website is investwithspark.com, and happy to talk to anybody about real estate. So if you have questions, reach out and be happy to have a chat.
Awesome. Well, Arn, thank you so much for sharing about your career and your story, as well as your 26 unit that you recently acquired, June of 2024, just to, in case someone's listening to this in the future, June of 2024 is when Arn and his company and his group bought that 26 unit that we talked about today. Arn, thanks again so much for joining us.
Yeah, Trent, a pleasure. Great to meet you. And let's keep in touch. I want to learn more about what you're doing also.
Of course.
Thank you for listening to this episode of the Real Estate Professionals Investing Podcast on WIN, your community of investing knowledge for growth. We hope that this episode has increased your knowledge and added value to your path to freedom. If you would, please take a second to rate us so that we can get more great investors to interview. If you or someone that you know wants to be on, please visit westsideinvestors.com and fill out our form to be on the show. Thank you again and enjoy your day.